Welcome to Aquitania Capital Management's webinar on how to build generational wealth in bull and bear markets with Aquitania's proprietary all-weather portfolio. Today's webinar is hosted by Christopher Carlin, Aquitania's founder and chief investment officer. Prior to founding Aquitania Capital Management, Chris was a successful money manager for some of the world's most respected firms, serving the needs of large institutions and the ultra-wealthy. For the last decade, Chris has brought those investment strategies to bear for individuals and families who've amassed significant wealth, but are too often underserved by the options and conflicts present at many brokers and advisors. Chris is a graduate of both the University of Wisconsin and the Yale School of Management and holds the prestigious designation of Chartered Financial Analyst. He has been a regular contributor to industry publications, has been quoted in the Wall Street Journal and the New York Times, and speaks at investment conferences around the world. It's my pleasure to introduce Christopher Carlin.
Hello, friends. Thank you for attending our webinar. Many of you are here today because you're concerned about your wealth and whether you are on the right path to securing your family's financial future. And I hope to leave you with a better understanding of your options and hopefully give you some peace of mind in deciding what actions your family must take right now to protect and grow your wealth. I understand your time is valuable, and I'm going to give a quick overview of what we're going to cover in this webinar. I know investing can often be intimidating, and I promise that I'll be speaking using plain, common sense language. I'm going to make sure that we are on the same page about what the goal of investing truly is about. I'm going to tell you about my story and purpose so you understand why what I'm saying may be important to you. I'm going to outline a common sense approach to investing that is simple but not easy. I'll give some information about my firm and our proprietary all-weather portfolio designed to protect and grow long-term wealth in bull and bear markets so that you can decide if we are best suited to help your family. Before we go further, the lawyers want me to read this disclaimer. This webinar is for informational and entertainment purposes only and does not constitute investment advice. I am an investment advisor, but I'm not your investment advisor and must issue this clarification to be compliant with securities regulations. There will be an opportunity later to get more information about becoming a client. So let's talk about what's happening in the stock market, since that's probably why you are here. The current situation is scary. Inflation is up, stock market is down, and the world seems to move from one crisis to the next. A year ago, investing felt so easy. Meme stocks, cryptocurrencies, NFTs created a fear of missing out on the easy money. But 2022 is a very different story. Even big-name professional investors have experienced massive losses. The S&P 500 and other indices have erased much of the gains of the last few years and keep falling. Over $9 trillion of wealth has been vaporized in the S&P 500 alone this year, more wealth than was destroyed in the stock market during the Great Recession of 2008-2009. Stock markets moving up and down over 1% a day don't seem like an efficient or an investable market to put your wealth into. And individual stocks have been hit far worse than the indices, with many of the market darlings of the last few years trading off 50, 60, 70, 80% or more from their highs. And the question on many of your minds, and why you're likely watching this webinar, is simply this. Are you on the right path? Do you own the right investments for your situation? What is your investment strategy and process? Does it all make sense? These questions reveal your biggest fear. Are you going to have enough wealth to do what you want, when you want, and with whom you want in your lifetime? Because wealth isn't really about money. It's about freedom. Our biggest fear as we get older is never attaining or perhaps even losing the freedom that we've worked hard our entire lives for. So let me ask you, are these questions that keep you up at night? Will you have the freedom to enjoy the benefits of working for 40 plus years? Will you have the freedom to work or not work on your schedule and terms? Will you be able to travel and take the trips you've been dreaming of for years? Will you be able to spend the time you want with your partner, your children, your grandchildren? Will you be able to help the people you love financially to make their lives a bit easier than yours was? Will you be able to give back to your community with your time and your money? Wealth gives you the freedom to live your life on your terms. Wealth gives you the power to say yes, and even more importantly, to say no. The stakes are huge and your emotions are understandably high because the simple fact is that you only get one chance at life, only one chance to get this right. And what's at stake is the difference between living the life that you want, the life you've worked so hard to attain, or serving someone else's dream because you didn't secure your financial freedom. I imagine you are attending this webinar today because you understand the high stakes, and the anxieties are commensurately high as well. And you're worried that you're on the wrong path, that your investment losses have given up most or all of the gains of the last couple of years. Maybe you're feeling lost and confused by what's happening in the markets. And if so, you are here for exactly the right reasons. And I'm thankful that you have invested your time to attend. You recognize there is a problem, and you know that the stakes are so high that you must fix it now. I'm sure many of you don't even want to open your brokerage statements. But you know that you can't just close your eyes and ignore it, wishing and waiting for things to change. Because hope is not a strategy, and nothing changes if nothing changes. So I want you to allow yourself to imagine for a minute with me. Close your eyes and picture how you would feel if you knew that you had a simple, common sense plan for your investments, tailored to your specific needs, managed by an experienced and highly qualified investor who communicates with you regularly to inform and educate you about your investments and your personal plan. Wouldn't that give you the confidence that you are on the right path to achieve your financial goals and realize the freedom you deserve? How would that newfound confidence feel today? Would it ease your anxiety and concern over the financial headlines? Would it give you peace of mind about your money today so that you can get back to focusing on your life, your work, and your family and be fully present in the moment? And I'll tell you a secret about investing. Fortunes are built during recessions. The opportunity to acquire great businesses at attractive prices is foundational to the returns you will realize over time. Warren Buffett has said, "Be fearful when others are greedy and greedy when others are fearful." But far too many investors make decisions based on the emotions related to rising and falling prices and do exactly the opposite. A strategy doomed to failure. There is tremendous opportunity now to sort through the wreckage on Wall Street, identify great companies at attractive prices, and put yourself on the path to low-risk, long-term wealth creation. Just like the farmer who plants seeds in the spring so he can reap the harvest in the fall, the seeds of future fortunes are sown during recessions. Furthermore, the investment landscape has changed in ways that indicate that the next decade could be much more challenging for investors than the last. For the last 14 years, interest rates were held down close to zero to help the global economy recover from the Great Recession. Low interest rates were a rising tide that lifted the value of many assets, including stocks and real estate. The easy availability of capital funded startups, and expansion by established companies, creating millions of jobs. That paradigm has ended. The pandemic changed demand drastically and caused supply chain issues that have resulted in an increase in the rate of inflation of goods and services. As companies look to reduce costs or are no longer able to secure necessary capital to continue, jobs will be lost and businesses will close. Energy prices have been relatively low over the last decade as a shale dividend benefited consumers. Investors in shale companies, in oil producers, saw over $300 billion in capital get destroyed over 15 years as shale companies increased production but could not generate profits. This amounted to a subsidy on energy prices that further benefited economic growth. That paradigm has ended. High energy prices serve as an effective tax on economic activity and may well persist long into the future. A world of higher interest rates, higher energy prices, and tighter capital markets is a very different world from the one that we've lived in for the last 14 years. We call it the Great Unwind. And the investment strategies that worked well in the past might greatly underperform in the future. So I hope we are all on the same page now as to what's wrong, what's at stake, and why you're here today. So who am I, and what does this have to do with you? I've worked in the investment management industry my entire career. I started out as a fund accountant before going to Yale for my MBA. There I met David Swenson, who ran Yale's endowment and was a leader in shaping how institutions invest. David became my mentor, and through him I was exposed to several great investors. He was a Midwesterner like myself and had very strong feelings about the inequities in the business of investing and how clients should be treated fairly. Leaving Yale, I worked for a variety of prominent hedge funds, mutual funds, investment advisors that provided world-class investment management services to institutions and the ultra-wealthy. In helping family and friends invest, I noticed how lacking the investment options that were being offered to individuals, even wealthy ones, compared to what was available to those with significant wealth, meaning wealth exceeding $50 million of invested assets. Furthermore, the knowledge of investments, including the differences between approaches and providers, was sorely lacking even among the wealthy and highly educated. I founded Aquitania Capital Management over a decade ago with the express intent to fill this gap of providing high-quality, unbiased investment management services to individuals and families like yours that have accumulated significant wealth but were underserved by the options available to those less than ultra-wealthy. As Chief Investment Officer of Aquitania Capital Management, I have delivered superior long-run investment returns to my clients without taking speculative risks by identifying unique companies around the world that I expect will be able to grow capital at exceptional rates over many years. I have distilled my 25 years of professional investing into our proprietary all-weather portfolio strategy, designed to protect and grow your long-term wealth. It's a straightforward style of common sense investing that has been proven repeatedly over time. It is simple to explain, but far from easy to accomplish. So let's talk about the principles of intelligent investing. First principle, invest in businesses, don't trade stocks. It's a common sense fact that some businesses are better than others. You see this in your daily lives. Costco is a fantastic business. It has scale, and it uses the purchasing power of that scale to constantly offer great products at great prices to its members, providing ever more value. Google is a fantastic business. Heck, it's even a verb. Dominating internet search and using that data to help advertisers best target their customers is a business that grows its value each and every year. Great businesses have greater control over their destinies, but far too many businesses are not so fortunate. Commodity producers, whether it's steel, copper, or oil, don't have control over the pricing of their products. They may be able to achieve some benefits from scale and being able to be the lowest cost producer in their industry, but they will never be a structurally advantaged great business. So it's not that hard to discern between great businesses and merely average ones. But this exercise does get a bit harder when you look at companies that aren't already established household names. Imagine looking at Google in 2005, the year they went public. The iPhone and decent mobile internet service were several years out in the future. YouTube had just been founded and you probably hadn't heard of it yet. There had been many search engines that came before, and it wasn't necessarily clear at first glance that Google would become the powerhouse it is today. But it wasn't an impossible exercise if you really examined it closely. Stocks represent ownership interest in businesses and should be thought of as such. The first step in analyzing any stock is to analyze the quality of the business, the dynamics of the industry that it operates in, and the caliber of the management team that runs it. And this is not any different from the process you would use if you were approached and offered to buy a stake in a business, say a store or a restaurant in your community. Of course you would want to see the financials, but more importantly, you'd want to understand the why behind the numbers. What makes this business strong or weak? What cash flows can it be expected to generate in the future? And are those cash flows expected to be stable or highly variable? How much control does management truly have over the business and its future? Principle number 2, let Mr. Market serve you, not the other way around. I imagine most of you are homeowners, and you've probably been in your neighborhood for a while, and you know it well, or you've moved in more recently and you did a lot of research on the neighborhood before you bought. You understand your neighborhood. You know what the schools and the shopping and transportation are like, the reasons why people like living there. You know what the houses, the style, and the size are, and what they have been selling for over the last few years. Now, let's imagine there's a gentleman who stops by your house every day offering to buy it. But each day, he offers you a different price. Some days he's feeling depressed and he offers you a low price, and other days he's feeling jubilant and he offers you a high price. And what I'm sure is already clear in your minds is that you know, without thinking, exactly how you would respond. Most days you'll politely say, no thanks, your price is too low, or it's a fair price, but I know that my house is going to be worth more over time and I'm inclined to stay put. Maybe if he offers you an outrageously high price, you might decide to accept his offer. And the reason that you can do this right now in your head as I'm talking is because of one simple fact. You know what you own and have a reasonable estimate of its value. Well, friends, the stock market is no different. Many factors amounting to unpredictable noise impact the market on any given day, week, month, or even year, pushing prices up and down. But the underlying value of great businesses rarely changes significantly over the short run. And recognizing this is the key to letting the market work for you instead of the other way around. If you truly understand a business, the factors that drive value creation, the dynamics of the industry it operates in, and the quality and incentives of the management team, you can estimate a range of values for that business with a high degree of confidence, no differently than you've already done so on your house. And once you understand what a business is intrinsically worth, you can look to purchase those businesses when the stock price is significantly lower than that value and sell when the price greatly exceeds it. And in between, you just wait and let the value of a great business grow your wealth for you while you sleep. I said before, investing is simple but not easy. It's not rocket science. It doesn't take an advanced degree or a genius IQ. But it does take experience, and it does take time. And if you're not able to dedicate that time to the task of investing your wealth, you better find somebody who knows what they're doing. Principle 3, have a long-term time horizon. Charlie Munger, Warren Buffett's partner, said, "You don't make money on the buying or the selling. You make it in the waiting. Nobody knows what is going to happen in the stock market in the short term, whether that's a day, a week, a month, or a year. This year should make that abundantly clear. Money that you need to consume in the next few years should not be invested in the stock market at all. It's too risky. Consider the example of your house that I gave before. There's a big caveat there that I didn't mention. The assumption was that you didn't need to sell, and that's what gave you the ability to let the market work for you. I'm sure you recall the Great Recession, where many people found themselves with houses they could no longer afford. And those unfortunate few had to accept the market price for their home just to stay out of trouble. It is essential that you manage and invest your wealth in a way that is not fragile, as this creates both the environment and the mentality to be able to capitalize on difficult times instead of being crushed by them. What's your reaction when your favorite store has a big sale? You might get there early and do some shopping. Now think about how you felt this year as the stock market's fallen. It's felt scary for most, even professionals. Maybe you bought a little more stock and it kept going down. And that feels not only scary, but it makes you feel foolish, right? But fundamentally, the stock market is just a store where the products, in this case ownership interests in companies, occasionally go on sale. The difference in your emotional response reflects the difference between having confidence in the intrinsic value of the products on sale, whether that's a gas grill or ownership in a great business. Principle number 4, volatility is not risk. Warren Buffett has said, risk lies in not knowing what you are doing. Stock price volatility presents opportunity for the intelligent investor who understands the intrinsic value of the businesses that they own a slice of through common stocks. True risk is simply the permanent impairment of capital resulting from a negative change in the intrinsic value of the business or the reversion of a stock purchased at a price well above intrinsic value. Warren Buffett's Berkshire Hathaway has one of the best records in investing. Since 1980, Berkshire has risen over 1,000 times, turning every $10,000 investment into $10 million over 42 years. Yet it hasn't been a straight path up. Berkshire has also had at least 5 or 6 major drawdowns of 30% or more over this period. Knowing what you own gives you the ability to take advantage of opportunities to invest more when a stock is priced below its intrinsic value. More importantly, it helps you avoid the even more costly mistake of selling a great stock prematurely simply because its recent price history is negative. At Aquitania, we stress test our business analyses under a variety of scenarios to determine a range for intrinsic value under very different conditions. This is where valuation is as much of art as it is science, with the overriding goal to reduce the risk of a permanent loss of capital because the business turns out to be ultimately worth less than what we paid. Principle 5, stay eternally curious. The world is a dynamic system and ever-changing. Businesses, industries, and managements can change in unexpected ways. Businesses are actively trying to crush their competitors. Recognize that investing is not a game of perfect, and it doesn't have to be to achieve superior results. Understanding major changes and shifts, constantly revisiting your investment thesis for cracks, questioning your assumptions. This is the common sense path to investing like a business owner to grow long-term wealth without taking speculative risk. As I said earlier, the concepts are simple, but the implementation is not easy. If this resonates with you, but you don't have the time or the interest in going it alone, you need to find someone who is qualified to invest on your behalf. Now I would like to introduce you to Aquitania's proprietary all-weather portfolio, designed to protect and grow wealth in bull and bear markets. When Jeff Bezos, founder of Amazon, met Warren Buffett for the first time, Bezos asked a simple question. He said, "Warren, your investing style is so simple. Why doesn't everyone just copy you?" Buffett replied, "Because nobody wants to get rich slow." I've spent over 25 years as a professional investor, seen multiple cycles, and every generation has a hot sector, and there's always been a fund manager that becomes a star and is viewed as a visionary until it all falls apart, leaving the investors, like you, with massive losses. Getting rich slowly is a perfectly acceptable outcome and far preferable to getting poor quickly. I've distilled my knowledge and experience into creating our proprietary all-weather portfolio to protect and grow long-term wealth through rational, common sense, and time-tested investing. I call it the all-weather portfolio because to grow long-term wealth, you can't just grow your wealth in bull markets. You also must protect your wealth in bear markets. To do both requires investing using the principles of intelligent investing I discussed earlier, but also a careful approach to portfolio construction. You may have heard of a 60-40 portfolio. This refers to a portfolio comprised 60% in stocks and 40% in bonds. The general idea is that the stocks would provide growth in good markets, and the bonds would protect wealth in bear markets, like the one we are in right now. This reasonable strategy worked well until interest rates went to zero during the Great Recession. And in 2022, the 60-40 portfolio is having its worst year ever, as rising interest rates caused both stocks and bonds to fall sharply this year. Bonds do have a place in managing your short-term wealth, money that you need to consume in the next few years. But until high-quality bonds can offer attractive absolute yields, they serve no purpose in managing your long-term wealth, as low-yielding long-term bonds can only expose your portfolio to risk without providing a commensurate return. The all-weather portfolio is divided into three slices: compounders, opportunistic, and ballast. Compounders are companies that can compound capital at exceptional rates over long time periods. The combination of both the ability to earn attractive returns on capital, as well as the ability to redeploy capital in the business at attractive rates of return, are what makes these companies such compelling opportunities. My goal is to identify these great companies early enough in their life cycle and acquire them at attractive prices so that we can hold them for a very long time, growing wealth while deferring taxes. Opportunistic investments are value and event-driven situations where there is both a sizable valuation discount between the current price and my estimate of intrinsic value of the business, and an identifiable catalyst event expected to narrow that discount. I've practiced this style of investing for over 2 decades. These investments are shorter term in nature, but are expected to provide a reasonable return that's not entirely dependent on what's happening in the broader stock market, as the realization of the catalyst event is what drives returns. Ballast investments provide stability to the portfolio and are a substitute for the piece that bonds historically played in a 60-40 portfolio. They include income-yielding stocks like real estate, some commodity stocks, other stocks in defensive sectors. In sharply falling markets, these stocks should fall far less than the market and can be a source of cash to invest in whatever exceptional opportunities may arise during stock market meltdowns. Many investors foolishly attempt to time the market or have a short-term mentality. My research process is focused on analyzing industries, businesses, and managements to identify long-term value creators and then purchasing their securities only when attractively priced. The all-weather portfolio therefore looks very different from the S&P 500 and other portfolios you may have seen or had. There are typically 30 to 50 stocks held, each one selected through rigorous, independent, fundamental research for their ability to protect and grow long-term wealth. The S&P 500 contains only US-based companies. The all-weather portfolio is global because there are great companies to be found all over the world to invest in. Why should you work with us? I built Aquitania with one simple guiding principle: create a firm that I would love to be a client of. I think you will find us to be demonstrably superior and pleasingly different compared to most firms you've worked with or considered for the following reasons. We don't do stupid things with your money. Stocks are selected for your portfolio that I believe are right for you. Each position is backed by intensive, independent, fundamental research. That doesn't mean that things will always turn out as we expect, but it means that we aren't buying for any reasons other than for your direct benefit, such as trying to mimic an index. We are an independent, registered investment advisor. We answer only to you. There is no corporate bureaucracy standing between us, and no corporate agenda that might not have your best interests in mind. Unlike all brokers and some wealth managers, we are fiduciaries, meaning that by law we must always act in your best interest. Transparency and access to the people making decisions about your portfolio. Relationships are built upon trust, and trust is built by performance and communication over time. I believe that the best clients are educated and informed about what they own and why, and I regularly communicate this in detail through quarterly letters, emails, and video updates that you can peruse at your convenience. This helps build confidence in how your wealth is invested so that when the inevitable bear markets occur, you will be assured that we can navigate it successfully. In addition, I'm available to take your questions directly at any time. This is access that most firms simply cannot provide, and other firms have layers of account or relationship managers whose job is to manage you, but they aren't responsible for doing the underlying research into the stocks you own or making any investment decisions. We eat our own cooking. My family investments are invested with Aquitania so that my interests align with yours. Investing is not a game of perfect, and I will make mistakes in buying companies where results fall short of my expectations. What I can guarantee is that mistakes will not occur because I am not diligent in my work or my incentives are misaligned with yours. Owning the same stocks as you puts me in the same boat with you in good times and in bad. Portfolios designed just for you. Portfolios are constructed based on the best opportunities available at that time. If we purchased a great company in other accounts whose price has increased substantially, we may not decide to purchase for a new account if we feel that better opportunities exist. In addition, all accounts are in your name as opposed to a mutual fund. So you own your tax basis and will not be hit with a tax bill for gains earned by other investors before you invested in the fund. In addition, we can accommodate your ethical and tax concerns. We will ask if there are any industries that you prefer not to be invested in or any companies. And we can work with you or your accountant at the end of the year if you need to realize or defer capital gains or losses for your tax planning. No conflicts of interest. The only fee that you will pay to Aquitania is our management fee, which is a simple percentage of your account's value. The value of that fee goes up and down with your portfolio, so our shared incentive is to grow your portfolio. Trade commissions are paid directly from your account to the custodial brokerage where your assets are held in your name. We do not receive any kickbacks from any brokerage firm, nor do we earn any commissions for selling products, because we don't sell any products. There are no fees to open or close an account, and you can terminate your relationship with us at any time without penalty. We never buy or sell stocks in our personal accounts ahead of our clients. Our incentives are simply to grow our clients' wealth and delight them with incredible service in order to retain their business. Before we go any further, I want to make sure that you're not wasting your time. There are lots of different firms that offer investment services, and I want you to find the firm that is right for you, even if it isn't mine, because we are talking about building and growing a relationship that hopefully spans many years, even decades. And whether in business or in life, relationships where you just aren't right for each other are no fun at all. My firm is a specialist investment boutique, and I am not trying to deliver all things to all people. I am only looking to help my clients invest the portion of their wealth dedicated for long-term growth. This means that portion of your money that you don't need to spend for at least 5 years, and ideally 10 to 20 years or more. Typical clients of our firm are working professionals and business owners in their 40s and 50s. We also help tech workers looking to diversify away some of their company stock risk while still investing for long-term growth. We also work with individuals nearing or in retirement who have accumulated generational wealth and are looking to invest their long-term capital to protect and grow wealth that is really accruing for their heirs. I emphasize communicating with and educating our clients. This starts with making a personalized assessment of your goals, your risk tolerance, and any other preferences at the onset of the relationship. We are limited to the number of clients that we can bring on in any year, and we generally only work with clients that have $500,000 or more to invest. However, I recognize that 2022 has been a tough year for investors, and that's probably why you're here. You may have had $500,000 or more last year that's fallen this year, and you're a bit under our minimums. I would suggest that you stay on the call, and if you're interested in working with us, I will try and be as accommodating as possible on a case-by-case basis. So who should work with us and how it works? We are not designed to appeal to everyone, but we are the firm you need if you are looking for low risk, intelligent investing oriented towards long-term growth, research-based global stock selection, full transparency about what your portfolio contains and why, custom-tailored portfolio and client experience, a direct line of communication with decision makers, no conflicts of interest, and a manager who owns the same stocks as you. So here's some more detail on working with us, on what working with us looks like. We do not custody your assets. They are in accounts under your name with Interactive brokers. You have access to those accounts directly through them. Our investment management agreement gives us only a limited power of attorney to enter buy and sell orders and debit your accounts for our fee. We cannot disperse funds to any other party. Clients must invest a minimum of $500,000, which can be separated into multiple accounts of at least $100,000 each. Given the sharp decline in the stock market this year, please reach out if you are near these minimums but have fallen short because of losses. We may be able to make an accommodation on a case-by-case basis. Our fees are 1.5% of assets, payable monthly on a prorated basis in arrears. We debit your account 0.1% of assets on the first business day of the month, based on your balance on the last trading day of the prior month. There are many options available to investors at fees higher and lower than ours. I believe that our fees offer tremendous value given our research-intensive investment approach and exceptional level of client service and access. We earn our fees in ways you will love. As an independent boutique firm, you will never be just a number with us, and we will give you the attention you deserve. Many investors who don't have the time or interest to invest choose index funds. Index funds are an effective solution in many situations. However, there's a big reason to be skeptical that the performance of index funds going forward will be as good as it was over the last decade. Index funds benefited greatly as interest rates were taken down to zero 14 years ago during the Great Recession. As we've said before, a rising tide lifts all boats. This period of financial history is over. Interest rates have risen sharply in 2022 and are likely to climb higher, causing investors to be more discerning between companies that are generating cash flow today and those that only trade on their potential for future growth. The tide is going out, and opportunities abound to invest in ways unavailable to index funds. Albert Einstein famously said, "We cannot solve our problems with the same level of thinking we used when we created them." There's a problem that needs to be addressed right now regarding how your money is being invested to protect and grow your long-term wealth. And I recognize that change is scary, and it's too easy to just put your head in the sand and ignore it, hoping the market recovers and you regain some of the capital you had 3, 6, 9 months ago. But hope is not a strategy. The stakes are exceptionally high, and you only get one chance to build the wealth that can give you the freedom to live the life you want. And nothing changes if nothing changes. So you must change the path that you're on, the path that isn't working. Someone is sitting under a shade tree today because somebody else planted one 20 years ago. The best time to start investing intelligently was 20 years ago. The second best time is today. I have told you about an intelligent, common sense investing strategy that has proven over time and has created great fortunes. It's simple, but it is not easy. If you don't have the time or the expertise to invest for yourself, you need an expert to guide you. And I have a 25-year track record of building long-term wealth for large institutions and the ultra-wealthy using strategies that form the basis for our proprietary all-weather portfolio that is designed specifically for families like yours. You know that who you work with is a vitally important choice. I have built my firm with an investor's first ethos, free of conflicts, and designed to delight you with our investing and our service. You know that working with an investor who owns the same stocks as you align your interest. Warren Buffett has discussed how people either instantly connect with the principles of intelligent investing or they don't. Most people, by definition, just don't get it. They would rather chase the latest fad, invest haphazardly, or just resign them to a cookie-cutter portfolio of index funds, mutual funds, ETFs. My intention and purpose is to delight each client with our long-term investment performance and outstanding client service. It only makes sense to become a client if what I've said today instantly resonated with you and you share my commitment to intelligent investing for long-term wealth creation. So consider the following questions to decide if working with us is the right choice for you. Are you seeking a low-risk, intelligent investment process oriented towards long-term growth? Would you love full transparency about what companies your portfolio owns and why? Do you deserve a custom-tailored portfolio and client experience? Would you appreciate a direct line of communication with the decision maker on your portfolio? Would you feel secure in working with a firm that does not have conflicts of interest in how they manage your wealth? Would you feel reassurance knowing that your investment manager owns the same stocks they purchase for you? So, friends, if you are ready to make a change and put your family on the path to low-risk, long-term wealth creation, and want to work with an investment manager that puts your needs first, and you meet our minimums, please click the button to schedule a phone or a Zoom meeting with me to discuss in further detail your specific needs and bring you on board. Look forward to speaking with you. Thank you for your time. We wish you all the best.